Well, good evening, everyone. This is AJ Monty with the Market Guys, and today we are going to go through our open house Q&A along with our rapid fire stock analysis session, which is a great time for really everyone to build their watch lists and to get some good stock ideas. We never fail to get a good stock to analyze, and it's usually submitted by one of our attendees, and we love to highlight those stocks because that's one of the benefits of being on the open house live session. Now, this is being recorded, so if you are listening to the recorded session out there in the future, obviously those stock picks may not be the perfect time to be buying or selling them, so you have to understand that. Just note the time and the day that we're doing this recording, and you'll be able to at least see what happened to the stock after we commented on it. Yeah, the Dow Jones Industrial Average has been going up steadily, and as you can see, it's also steadily moving away from this 200 period moving average, which is the red line there. And the more this market drifts away from that period, that 200 day moving average, the greater the risk of a dramatic sell-off. And I'll take a look there. Look at the monthly chart, and you can see this is one of the longest sustained bull markets we've had, at least in my lifetime. But look at how steadily the volumes are dropping, particularly in the last 6 months. I'll zoom in here for you. You have to really look at how steady this is. Look at that. Month after month, for 7, 8 months now, the volumes have been drying up. And that's usually what we see just prior to a sell-off. Remember, the first thing that happens before the sellers start to take action is the buyers stop in their buying action. So the buyers stop first, then the sellers start to accelerate. Another thing you want to look at, and this again is a monthly chart of the VIX. This is a 20-year low of the VIX that we're on right now. It's 20 years. So when the VIX is on the lows between 10 and 12, and right where we are right now, you are more or less looking for a corrective move, because the VIX is a contrarian indicator to the general S&P market, the S&P 500. And again, I'm going to zoom in here for you so you can see some of the details that I'm looking at. This is a monthly chart. Remember, monthly chart, and we have a bullish engulfing pattern on a monthly chart. And that's significant because this month so far, the low is right on that 20-year support. Last month, here in June, the low was right on that 20-year support. And we have a spinning top from last month, followed by a bullish engulfing pattern this month. So, what does that mean if the volatility index is primed for a rally? It means watch out below in the S&P. So I'm just kind of stacking the deck here for you, showing you exactly what's going on so that you're not caught off guard. You know, a couple of phone calls today, I had some discussions on the big shakeup in the BRICS. That's Brazil, Russia, India, China, and South Africa have just completed their BRICS summit. This is a financial summit where the BRIC nations are coming together to create a monetary fund that is going to be second to the IMF, the International Monetary Fund. And you have to understand, right now, China, the yuan, especially the currency there, is the second most popular currency in the world, second to the dollar. And their goal is to make the BRICS nations the strongest economically, and if that means shutting out any countries that work in the American dollar, remember they've been doing this for a long time trying to take control, you're going to see a global earthquake like we've never seen before. And that means for those in North America, your quality of life could dramatically turn the other way because your buying power is going to quickly diminish. When the valued currencies that you're trading right now become less valuable, that means you have less buying power, and everything around you becomes more expensive, especially the imports. Now, I'm not telling you that to scare you in any way. I'm telling you this to prepare you. All the writing is on the wall here. The VIX is getting ready for a rally. The Dow Jones Industrial Average is getting ready for a sell-off. the S&P, I'll look at this right here. S&P 500 through the spiders is again looking overextended from the support level and overextended from the moving average. Again, if I look at the monthly chart on the S&P, look at this. This is even more dramatic than the Dow. I'm going to do something here on the S&P that I normally don't do because it's not an indicator that everyone is familiar with, but I'm going to describe this for you. If I go in here and I select the Fibonacci numbers, I'm going to look at, I'll add a drawing here. I'm going to add the Fibonacci's. Where are they? They're in here somewhere. I know they're in there. Where is? Hold on, I got to clear this out. There we go. I'm going to add the Fibonacci retracements right there. Every chart program that I know of right now has added the Fibonacci numbers, and let me explain to you what this is, and we will be using more of them in our analysis, the Fibonacci numbers in particular. Now, the Fibonacci numbers was developed by a mathematician, Fibonacci, who found a particular sequence of numbers that was very common, not just in average numbers or sequences of numbers, but in angles found in nature, in human behavior patterns, in weather cycles. And when you apply this mathematical sequence to the stock market, it actually helps you develop pullback points, with one of the most important pullback points being the 50% retracement level. And I'll show you. To start off the Fibonacci retracements, what you do is you pick an obvious low, and you can bring it pretty much to any one of the highs. So if I pick this low right here, and I drag that up to a high, all I have to do is connect the low to the high. You'll see that it breaks it down into percentages of retracements. And again, this is based on the mathematical sequence of the numbers and how the difference in the numbers remain constant. The 50% level right here is what we expect to see in most dramatic rallies. We expect to see a pullback of at least 50%. And you can see here from the low in January 1995 to the high of 2000, right before the crash of 2000, we see eventually we came back to the 50% level. Again, if I apply these numbers to the second bull market, which by the way is in a 7-year cycle, if I go to this low to this high, again, you see where the market pulled back. It pulled back 100% of the Fibonacci retracements. 50%, it blew right through, went right to 100. Now let's look at this and compare it to the most recent bull market. Again, I'm taking from this low to the most recent high, which is what we have this month. We reached an all-time high. There we go. Where does that bring us? Interestingly enough, I'm going to change my numbers here, okay? Interestingly enough, the 50% retracement brings us very close to a role reversal support that's taken from this April high back here. So look at the dramatic pullback. If I get rid of my 50%, my Fibonacci numbers now, and I just leave my role reversal, this is what we are expecting the S&P to pull back to. And that is just the 50% retracement level. This is a very realistic pullback point, because if the S&P pulls back, it could very well bounce off of that level and go back up, and we could see another rally. That's not the issue right here. However, if we pull back to the 50% level and we break through that level, it could go all the way back to a support of 70 for the S&P. Now let's go back and look at the diamonds, and then I'm going to use this in the Qs as well. I'm going to use the 50% level. Okay, let's get rid of that line. I'm just right-clicking. For those of you that use Thinkorswim, this platform is on there. You just go to the drawings, you pick your Fibonacci retracement levels, boom. You go that low to this high on the Dow. What's 50%? There you go. It's right around the 117 level. And that is a dramatic move, because remember, we're looking at the diamonds. If the diamonds or the Dow pull back to the 50% retracement level on the Fibonacci numbers, you could see a 6,000 point drop in the Dow without even hesitating. It could go right down in a very quick fashion. It could also drop 100%. Again, not to shake up anyone here, but I am expecting more than a 100% drop in the Dow. I'm just expecting that. I think that the economic situation, what's happening, is being ignored. I see the Fed, through Fed Chairman Yellen, already putting warnings out of a bubble bursting. I mean, Google Yellen on bubble burst. Just Google that. Yellen, that's our Fed Chairman, newest Fed Chairman. Yellen, Y-E-L-L-E-N, on bubble burst. And look at all the warnings that our Fed Chairman is putting out with regard to a possible bubble forming and bursting. When you have a Fed Chairman coming out and making these warnings, something is up. And when the market rallies in the face of such warnings, that gets me even more concerned, because there's an old saying, you don't fight the Fed. You do not fight the Fed. If the Fed Chairman is talking about a possible bubble burst, what she's doing is she's covering her butt, really, to make sure that she goes on record that she won the general public, and she doesn't want to be, in an I told you so situation, but she definitely wants to go on record to say, we warned about this. And so I'm telling people to prepare. There's lots of good things that you can do right now to prepare for a pullback. And let's talk about that. Let's go to the Qs. Q. The Qs, although not as dramatic of an upward turn, this could still pull back to a roll reversal right here, right around 70, which would be a dramatic move for the Qs. But if you look at what this Fibonacci retracement level could look like here, again, that could bring us closer to 60. $60 from $96 on the Q. Again, very conservative, because if I go back and draw my 50% retracement, that's bringing us again to a roll reversal point. I'll delete this and show you all over again. It brings us to a roll reversal point that is something that we could actually invest off or a trade off of and still be okay. So right there is what we're looking at as a 50% retracement level. That, look at this. Technically, that's not far-fetched of an idea. And again, if you look at the monthly volume on the Qs, again, it's dropping for 4 months in a row now on almost vertical volume. So we're going to start to see red candles showing up on the Qs as well. So going back to my idea of what opportunity is out there, well, SLV. I've been talking about silver for a long time. Again, I'm looking at monthly charts so you can get an idea of where we are. I'll draw these lines for you. Where is a 50%? Where is a roll reversal line for silver? Right around there. You get these highs from back in December of 2009 and into April of 2010. Draw them across, and you got a bullish engulfing pattern right here on silver with a pivot point forming right around 20. In the last open house session, I talked about silver, and I talked about the mining of silver. It costs about $17 to $19 an ounce to pull silver out of the ground. So as it reaches and stays on this bottom, production slows down because there isn't a profit margin there anymore for the miners. And as the production slows down, that creates more demand because there's less silver. Now remember, silver is also an industrial metal. It's used in computer components like gold. It's used in developing of certain films. Although digital is quite common, there's still a lot of applications for silver on an industrial side. It's a great conductor of electricity, and it's also a precious metal for obvious reasons like jewelry and such. So silver is primed. Again, it's starting to form that pivot point. Look at gold, GLD. For those of you who have subscribed to the Oracle services, I talk about these quite often, and we have positions in these. Look at gold, bullish engulfing pattern, a bullish engulfing pattern on the monthly chart. Why am I pointing that out? Because if you look at any other time, right here was a bullish engulfing pattern. Look what happened to gold after that. Right here, bullish engulfing pattern. Look what happened to gold. You can go back 20 years looking at gold, and every single bullish engulfing pattern that was formed resulted in a market that was much higher than where gold was when the pattern formed. And they don't come all that often, but when they do, they're 100% accurate on the monthly chart. So I don't believe what anyone says about gold not being a good investment right now. I think it's a great investment. And if you think gold is too expensive for your taste right now at 126 per share on GLD, then all you have to do is trade IAU. IAU is a cheaper version of GLD, so it makes it more affordable for someone who has a smaller account. You see, the same thing applies. You got a bullish engulfing pattern right there, just like you did on GLD. You have the bullish engulfing pattern back here, same thing. Again, 100% accuracy in the bullish engulfing patterns. Don't ignore it. You know, the question came out from Ron, and I'm going to read this right away because it's going to set the tone for the rest of the session tonight. And Ron says, after buying a stock and it immediately goes down, should you sell it then or wait for the stop loss to execute? Well, Ron, let me help you with this, because the stop loss order is a pre-calculated stop loss instrument that prevents you from taking a catastrophic loss. So in other words, you leave the stop in place until it fires, unless or until you see an obvious bearish engulfing pattern or something that is so bearish that it tells you, I'm not going to wait for my stop, I'm just going to get out. And a lot of times the bearish engulfing patterns will be quite accurate, but generally when you put a stop in, you shouldn't mess with that order too much. You should wait for the stop to execute, and we're going to go over some examples on how to do that as we analyze the stocks brought to us by the members today who are watching. So let's go right into that. Let's give us who wants to submit the first stock. Let's take a look at this. All right. PB says, what is the best way to hedge against the market drop? Well, we're going to talk a lot about that today. We talked about gold and silver already. There are contrarian indicators that you can look at, like the VIX, that you could also trade. So when the markets are getting ready to drop, the VIX will go up and you can invest in the VIX. Buying puts on indices, you got to be careful with that. You got to make sure you're buying the right put. But for those who are subscribing to the Options Oracle, we put in strategies that will be quickly shifting now to bear market strategies. I've been riding the bull just like every one of you, and we've been doing really well with our spreads. But I will be shifting to bear market strategies so that we can make money on that. So be sure you tune in to the Options Oracle especially. Okay, another question comes from Danny. What should you move to protect yourself? I'm not quite sure what you mean by that, Danny. Maybe the stop. Once a stop is in place, you don't want to move it. Okay, just don't want to move that. Okay, Paul suggests AUY. Now, when you submit your stock, if you could, please let me know if you have a position in that stock. Okay, that would be good. Yamaha Gold is I'm going to go to a daily chart here. Yamaha Gold right here looks very, very good as far as a buy, but the buy signal has not occurred quite yet. And I noticed something when we first pulled this up. I must have analyzed this before. I'll go back to the weekly chart, the monthly chart. It looks like Yamaha Gold has been in an upward trading channel for a while. And although it violated the bottom trend line, it's done that before, it looks like it's on track to pop up over this again. So now that we've observed that, you could use your Fibonacci numbers on the way down too. Watch. If I want to use the Fibonacci's to calculate what my rally point is, then I take from a high to a low, not a low to a high. So I start from the high, and I go to the low now, which is right at the bottom of that spinning top, and a 50% retracement would bring us just below 14. on Yamaha Gold. Now that's a dramatic, so it doesn't look like much on the chart, but if you're buying this at 835 and you could get this to rally to 14, you're a hero. And so the Fibonacci numbers are telling us a 50% retracement of that downward leg could conservatively bring us to 1382. So keep that in mind, Paul. That's this is a great one that I would keep on the watch list. And now that I'm removing all my drawings, let's go to a daily chart, because I saw something there that is very interesting. Now, here's a test question. For those of you who are the seasoned chart analysts, what kind of pattern is starting to form on Yamaha Gold here that I could highlight here for Paul? Can anyone tell me? I'll wait for that. There's a little bit of a delay there. Nicole, you were the first one. Brian, you were the second. Rick, you were the third. Yeah, everyone. Scott, Gerald, you all said it. Cup and handle. Yes, Ken. Yes, Rob. Robert said double bottom. I could see what you're talking about back there. But what's happening here is we have a cup right here forming and a handle. There's the handle pattern. Now, the rim, I call it the brim. They call it the rim, R-I-M. The rim, let me get my drawings correct. Go to a price line now. The rim occurs from these resistance points back here where you see a bearish engulfing pattern and this. I'm going more with this resistance area. Now, the buy signal, and it's going to be it'll probably be a very strong buy signal, because watch what happens. Here's the brim of the cup. Once the price starts breaking above the brim at the handle point here, it'll break out of that resistance and it'll most likely rally. What is the resistance level matching up with right here? Oh, lo and behold, that's the 200 period moving average. When the 200 period moving average coincides with the resistance point and you get a break of that, that's even a more powerful breakout that I would love to capture. So I would tell everyone on here to put an alert on this one and have it notify you when it trades over, let's say, 890. And I'm going to do that right now with you. I'm going to put to notify when it's trading at 890. I'm going to put this in there. So when the stock is trading greater than 890, I should have typed it in, it would have been faster, but I could do it this way too. When the stock is trading 890 or greater, what's going to happen? Oh, what's going on here? I'm just going to type it. Okay, 8.9, there we go. So then create, boom. Now what my system is doing right now, I just set an alert. And again, most of you have alerts set like this. If you're from Canada and you're using the Scotia deck, then you could do that on the flight desk. You could do it on Yahoo Finance. They allow alert services that will email you the alert. So when the price is trading greater than or equal to 890 right here, I'm going to get an email alert. And I'll know what to do because I'll look at the chart and I'll see it's breaking out. So everyone should be putting this on the chart because this is a great hedge against a falling market. Okay, so this is a gold company. But for those of you who train the equity oracle, you'll know that I've also gotten us into NUGT. NUGT is a bullish minor stock, but it's 300%. It's 300% greater in volatility. So whatever that percentage is in the minor index, this will trade 3 times as much. So it's a leverage contract, and we are already long this. We got long. I think we got long on this day right here. I have to check. I think it was on this day. Yeah, the 17th. I sent out the alert to buy this one. And it looks like it's doing quite nicely. Today we had a higher low and a higher high, even though it's a red candle, higher high, higher low, and I think this one can go up as well. So thank you for that selection there. I really appreciate that, Paul. And we're going to go right down. Now Ron says HPJ. He doesn't own it, but let's take a look. Now remember, if we're expecting a pullback, and the Fed chairman is expecting a pullback or a bubble, you don't want to get too aggressive in your long positions. Does that mean don't buy anything from here on out? No, that's not what I mean at all. It means be ready, because you can't wait and watch all of a sudden all the moving averages breaking down and you're still buying in the face of these sellers. This too has the potential right here. High power looks like it could very well go higher as well. Where's the drawings here? Get rid of the drawings. Okay, now high power, although that could be construed as a cup and handle, this one also looks like resistance up here around 5. I would be a buyer of this one. I like this stock. It trades with nice volatility. It trades technically. If you want to jump in early before a breakout, I wouldn't be against that, but I would certainly put my stop somewhere right below this low. So if you buy it at 484, I would put like a 70-cent stop loss beneath it, and then just let that stop loss sit there. And that's what I would do with that one, Ron. Okay. Kevin Atkins. All right, Netflix. Let's look at this one. Netflix came out with earnings today. I don't know if you're aware of that. I was talking with Scott earlier today. We were watching this one after the market closed, and Netflix rallied, came back down, rallied, came back down, then it kind of settled. Actually, we still have the post-market or after-hour market candle there. You see that? This is after hours. At least they had the high. Okay. So what happened is the stock rallied a little bit, stayed in here, but they only beat the earnings expectations by a penny. And then if you look into some of the news, the company actually set a negative tone on the third quarter. And you have to understand, Netflix, the PE ratio is out of this world already. So fundamentally, there's nothing that drives me to get this stock. I'm pretty bearish on this one, actually. And so I wouldn't be buying. Ron, you say I'm sorry. Kevin asked to buy a put. I wouldn't be buying a short-term put on this one at all, Kevin. But what I would be doing is I would be either selling credit call spreads. You can sell out of the money credit call spreads that are pretty generous, actually. Let me show you. If you're going to sell a call spread, then you sell the front month. If you're going to buy an option, you buy the back months. But if you look, with some of our clients actually in this one, you could sell. Look at this. The stock is trading 451. The 5-10 calls, look at that. The 5-10 calls is still trading over $4. So if you want to sell a credit call spread, you could do that, take in a credit, and that will not be at a risk point until it starts climbing over 510. Now let's look at the chart. Okay, I got to move I have to actually adjust my chart to have you really see this, because there's no scale up here. Okay, so if you sell a 510 call spread, that stock has to rally. Again, it has to rally $60 between now and August for you to lose money. And Netflix can do that, but with the way the company positioned the earnings for third quarter, it doesn't look like they're going to be too optimistic. So I'm bearish on that. Now, if you are an equity trader and you're not trading options, let me get rid of my lines here, and you're so bold to short this stock, then you have to, if you're going to short the stock, then you have to put a buy stop in above 474. You do not want to be short this stock if it starts breaking out over that resistance point. So the better bet is to learn options and trade those, because it's safer. You can limit your risk. You can sleep at night and still capture a pretty decent return on your investment. All right. I'm going to scroll down to some of the folks that I haven't gotten to yet. Let's see. Who wants to put in another stock symbol? Let's see. Brian has a question. How about the gap? Okay, Brian, which gap are you talking about, on Netflix, or are you talking about the other stock? All right, I lost your question on that one. Sorry. All right, Danny has a question. If you have a 401k, what type funds should you move into to protect yourself from a falling market? Bonds, money market, oh, that's a tough one because you really can't go into bonds, Danny, because here's why. I say you can't go into. There's going to be some people that are going to try to talk you into bonds anyway, but the Fed chairman is most likely going to have to start increasing interest rates. And the bond market is inversely related to interest rates, so if interest rates start going up, then your bonds are going to go down, right? There was an article that I posted here as well, Danny. You might want to read it. If you go to the Market Guys Facebook page, I posted this article today from Forbes, and this is one of the things I was talking about with the bursting bubble, how the Fed chairman was kind of warning against that. Danny, this is going to be a great read for you. If anyone, again, wants to read this, it's not an easy read, but you can get the gist of it. They do talk about the quantitative easing. They talk about interest rates and the Fed's policy towards zero. It goes into this, and they'll talk about credit, risk return. They give you the charts. They look at all the leveraged, structured products that are out there. It's very, very in-depth report. Forbes does a great job, I think, in putting together reports like this. And if you're inclined to read this, I think you'll get a good education as well. And Danny, this will help you with making that decision as to where to move your money. If you still feel inclined, let's say you're moving more towards fixed income, then the only thing I would suggest is that you find a precious metals type of a fund and then ladder yourself into a bond ladder as rates are going up. So in other words, what happens is the short-term bond instruments or interest fixed income tools, they will have the lowest interest rates. And you keep that money short-term, but as interest rates start going up, the long-term bonds will start to get higher rates. So when the front month expires and your money is now in cash, you can throw it at the back of the month. You're not putting all your money into that long-term bond. You're dividing it into ladders, month after month or quarter after quarter, and as the front month come to maturity, you then roll that money to the back and you can at least stay current with interest rates. That's a very popular fixed income strategy for retirement funds, Danny, and you might want to go talk to a financial advisor to structure you with that. But don't let them talk you into annuities right now. Don't let them talk you into putting a bulk of your money into very low interest-bearing accounts. That doesn't make any sense. I mean, our option traders are finding anywhere from 5 to 10% a month in the option trades, and that's really tremendous. But again, the option traders are not putting 100% of their money in that option strategy. They're spreading it out, diversification. Okay. All right. Now, Bruce says, what about GME? I've been building on my position. Let's look at GME, and let's take a look at that. GME. There we go. Okay, GameStop Corp. All right. Looks like another kind of convoluted cup and handle pattern there, really. Can anyone see it right there? Here's the cup, and here's a little bit of a handle. It looks like it wants to try to break out here, Bruce, but it didn't quite do it today. If you zoom in, you'll see we had a little bit of a hesitation there right at the 200-period moving average. What you want to look for, Bruce, is you want to see a breakout here, and you want to see an increase in volume, not a decrease like we saw today. There's a chance that this could pull back a little bit tomorrow. But be careful. You would if you already have a position, you have to watch out because you have a gap down here right below 38. So be careful of that. But if it breaks out on high volume, you could even add to that position, because if you look at the weekly chart on this, it's going to look like it's going to look slightly different. You'll see that you have almost a double bottom forming here. The only thing I don't like is that gap down there. That's an interesting piece of information. In trading gaps, you got to watch out. Okay, Eduardo says HMST. He has it at 18.5. Should he sell it or hold it? HMST. HMST, there we go. All right, the weekly chart is not looking that great, Eduardo. You have it at 18, so it's pretty close to where it is. Keep an eye on this. This is a role reversal support level. You see the resistance from back here was broken, held support here, 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 and recently. Now that we know where the role reversal is, I don't know where your stop is, but your stop should be somewhere below 17. Now that we look at a daily chart, let's see, do we see any bullish signals? Almost had a bullish engulfing pattern here yesterday or Friday, but you have more bearish engulfing patterns showing than bullish. So I'm not happy about that. You need to put your stop below 17. What you need right now is you need a little bit of a pop to complete this pivot point, and then your next resistance point is going to be up there around 19. So, Eduardo, if you get a chance to sell this at 19 after buying it at 18, I probably would take that. I would take that because of what we saw on the weekly chart. This is still in a downward sloping trend right here, and if I was to connect the trend line here, you'll see if I take this high and connect some of these highs, you'll see there's pretty much what the trading channel looks like right here. You see that? That's a downward trading channel, and you're right at that support level. Again, that's why I tell you your stop needs to be right below 17. So you'd be suffering a $1 risk per share, but at least you're protecting your position against a catastrophic loss should it occur. All right. Ken says SWHC. He has a long at 1355. Let's take a look at HWSC. HWHC. All right, come on now. There it is. Smith & Wesson. I love this company. Love it, love it. You have to understand, I live in Florida. As a hobby, I love to shoot guns. I collect guns. I've been watching the price of ammunition and handguns especially go up like I've never seen before, and I have been actually investing in such items like gold. I mean, I get a better return on Smith & Wesson products than I do on actually having gold in my safe. And this is a weekly chart. Look at this. Look at this trading channel here. Let me see if I can get that for you. Draw that. Look how beautiful this is right there. There's your trend line. Here's your channel line. If you're interested in learning how I did that, all I did is I drew the trend line connecting these lows, and I drew a line parallel to it connecting as many highs. And there you go. There's your trading channel. This looks very bullish on the weekly chart. And keep this one on your watch list if you don't have it. Ken, you're long it right where you should be long it. There's the weekly chart. Now let's go to a daily chart. Where's your stop, Ken? I'm going to ask you that. If you're too embarrassed to tell me, it means you don't have one. But, all right, Bruce, I'll get to you. Hold on. All right, we got, where's your stop on HWSC? Let's see. You're going to put one in there? All right, you have one at 1270. Perfect. You got your stop down there. That's perfect. Okay, that's right where it should be. Now, let's look more closely at the price. Let me get rid of all these lines that I showed you here so we can clean up the chart. I like clean charts. Notice I'm only showing the 200 period moving average. Can anyone tell me if there are buyers or sellers on that 200-day moving average? Past 4 days, we've had buyers, right? I would love it if the volume started to pick up. I'm not too upset that it hasn't picked up yet because I'm happy that the volume dropped because that tells us the sellers have moved in and they're slowing down. There's a couple of reasons why I really like this one right now. Number one, it's cheap. Number two, the technicals on the weekly chart still show us in an upward channel with this bouncing off the trend line. We have a gap above the market. That's number three. So there's a gap that could bring us all the way up to 1670. And I like the fact that when this stock rallies, notice, it usually rallies for a good period of time once it starts its pivot points. You see here? Look at this. There's a leg. A leg is from a low to a high. There's another leg. Here's another leg from that low to that high. Notice. So if I was projecting, trying to keep the same angle, I think there's a good chance the stock could do that. Even if it doesn't come all the way up to the gap, heck, I'll take 16 from a 1373 entry point any day. I love that. I like that. So that's that. I think everyone should put this one on your watch list as well. This is a great trade candidate, and you know when you have to understand, there's the people out there that are just not going to get rid of their guns. They're just not going to get rid of them, and there's a stockpiling going on because the cost of ammunition, thanks to Homeland Security, has gone up. The Homeland Security created so much demand when they started buying ammunition, and enough of it for World War whatever. They have enough ammunition to sustain them in a war for many, many years. They create such a demand for ammunition that the cost is going up, and so are the guns. And so people are collecting them, and they're hoarding them. So there's still a lot of opportunity on the upside for this one. That's the fundamental story. Let's get to Bruce. Bruce, I think you are going to go down on record for typing in a symbol the most times out of any member. It worked, though. All right, Bruce wants me to look at CL. He's long it at 66. Bruce, you're in great shape. And look, looks like we analyzed it way back here when we were looking for a pullback in the rally, and we got that. But Bruce, looking at this on a daily chart, I like it. Let's zoom in a little bit more. I want to see if there's any roll reversal points. Yeah, there are. All right, here I'm gonna erase my lines. Can anyone tell me where I should draw my roll reversal on CL? This is Colgate-Palmolive. This is a tough one. This is a tough one, but I'm going to see if anyone can tell me where I should draw my roll reversal line. So I'm going to wait a little bit. Roll reversal, for those of you who know. Oh, Brian, right on the money, man. Oh, Robert, you're good too. Scott, yeah, good students. Tim, Nicole, you all got it. Look, I'm going from these highs back here. Now, let me hit the pause button for a second. There are people on here who have no idea what I'm talking about with roll reversal, so I have to explain to those folks. Because this is a basic idea in chart analysis, and this basic idea that I'm going to define for you could make you millions upon millions of dollars in the market. I'm not kidding. What you do is you look back in the past, and in your mind's eye, you have to try to find an area that was once resistance and try to connect it to an area of new support. And right here, if I draw that line, oh, I clicked on the wrong line. I got to get a price level. Okay, price level right there. Okay. So if I take this high and connect it to this high, look what happens. Boom, I drop it right there. It doesn't have to be exact, folks. And we have a video on the Market Guys website that shows you how to draw this line. Go there and refer to that. A former resistance, again, former ceiling, once broken, turns into the floor. That goes over and over. Look back here, same thing, right? Former ceiling back here turned to the floor. If I go back even further, I could probably find some more. Let's see. Yeah, I could. Former resistance right here, right there at that high, turns to support here, and so on and so forth. So, looking at the most recent roll reversal, right around 67.5 is where I'm drawing the line. Now, Bruce, you bought this at 66. So, if you put a stop at 67.5 or even 67, you could still protect your profit while at the same time still giving this stock room to grow on the upside. Now, here's what's going to happen. Let me draw the lines again. I'm going to erase these and draw new lines. If I zoom in a little bit more, there's another minor area of roll reversal. Again, remember I said you don't have to be exact. Here's a general area of resistance. See, the stock went up, boom, came up, boom, came right back down. Right here is a slight area of resistance that it broke through, and it looks like today it's holding that. So, Bruce, if I were you, I would move my stop up to around 68.20, because then you're still protecting $2.20 of profit. And if you get stopped out, don't worry, because chances are if you get stopped out, the stock will come back down and bounce around here again, and giving you another chance to re-enter the position if, in fact, the buy signals come back in. All right, so that's something you really need to pay attention to, because you don't want to turn a winning trade into a loser, especially when there's bubbles floating around out there. You know what I'm talking about there, we just did with all the talk of a possible downward market. Okay, Lewis, Tesla, TSLA, I love this stock. Look at this one, folks. This thing is roaring in price. And the reason I have lines up here is because I was looking at this today as a possible candidate to trade, and lo and behold, Tesla is bouncing off of a roll reversal line. See? Former resistance. Once broken, turns to support. Doesn't matter which stock you give me, we're going to find that line. And that's why it's so powerful, because it's found in almost every stock. You just have to learn how to draw it. So, Lewis, you gave me the stock symbol, but I'm not quite sure what you want to know about it. It's an expensive stock, so you know, I would say if you have a lot of money in your account, go buy shares in this. But I would never buy anything less than 100 shares, because it doesn't pay to buy one share of anything these days. The other way is to trade options on it. You could sell a put spread, you could buy a call spread, you could buy a long-term leap. There's lots of ways to get long that one, but the idea is to get long, because it looks to me like the sellers have stopped selling, and tomorrow especially you want to make sure that there's a higher green volume there. We have a series of higher highs, higher lows here, which is telling me the pivot point is starting to form there. Okay, Ron, let's look at PDLI. He does not own that, but maybe Ron is giving us he's giving us a candidate. Let's take a look. Okay, PDLI, Biopharma. That looks like a buy to me. Pretty quick on that one, because I see a bullish engulfing pattern right at a roll reversal point. You see that? Boom. There's a roll reversal. And on Friday, you see the bullish engulfing pattern? Can anyone see that? Boom. Big green candle, and the volume is increasing. So to me, this is a no-brainer buy. Notice I haven't even checked the fundamentals on that. I'm a technical trader. Of course, you want to make sure that earnings aren't coming out tomorrow, and you want to check that. There are some option positions that I'll put on before earnings, but if you're buying a cheap stock, you want to watch out, because the cheap stocks could react very, very quickly on earnings news or disappointments much faster than the higher priced stocks. So you got to be careful of that. But this one looks like a buy, and if you buy it at 946, I would give this room. I would really give this $1 risk per share. I'd put my stop somewhere down here. I would give it $1 risk per share and put my stop somewhere below the 200 period moving average. Now remember, when you are buying a cheap stock, you could buy more shares, right? Yeah, obviously, more shares. With the buying power you could buy, it's a cheaper stock. But if you're buying a cheap stock, you should give it more room. $1 risk per share, what that does is you take the value of your account, take 1% value of your account, divide that by the risk per share, in this case is 1, and that'll tell you how many shares you get to buy. I really like that one. Hopefully everyone else is putting that on their watch list as well. I'm looking at the clock. I'm trying to get as many of these as I can. Oh, Rick, I got to look at KAG for you, because I was looking at that one today too. This is one we traded, and we bought this one. We really hit a home run on this one. For those of you who traded this with us, this was an equity oracle trade. We bought it down here, right near the lows on this bullish engulfing pattern, and I had everyone get out here. Even though it was a green candle, I had everyone get out because I saw it stop. It like it hit the brakes right at the 200 period moving average. And this is actually the line that I drew from my last analysis. I said that this stock could very well pull back before rallying again to fill the gap. And I'm telling you, Rick, this looks like it could be another get in. I just didn't see a green candle today. We saw Friday, we saw a Harami, which is bullish. But if you see a green candle tomorrow, this would be a good buy. I really like this one because you still have this gap up around 32.5 up here. And that's still a nice move for the stock. If you look at the weekly chart, this one trades very, very technically. Look at that. And it still looks like it's holding. So this line, remember, on the daily chart represents the gap fill. If it fills that gap, I would not stay long it because watch. Let me get rid of that again. See, if it hits the gap, it's probably going to pull back and prevent the stock from breaking out of the downward channel. So after it hits the gap, it's probably going to pull back again, and it'll give us another chance to trade that. All right, Louis, you have options on that? Okay, that's good. Good. You have the long lead, so I feel much better on that. So, yeah, Rick, I don't know if the signal is strong enough, though, for me to put that out in a trade alert for our members. But being that you asked me, I think that there is upside potential here. I'm just finding better and cheaper long positions that I'll probably be putting out on Wednesday or Thursday. So keep an eye on your mailbox. By the way, if you're not a subscriber, we started this. My partner and I, Bill Shanley, who's listening in and recording, we started this service, this monthly web seminar, as an added value to our subscribers. But we didn't limit that just to our subscribers because we found it to be a great business development tool. And if you're not a subscriber to our Oracle, you might want to do that because this thing is paying out. Get ready to do a screenshot, folks, because I'm going to show you. I'm going to show you my. Let's see if we can do this. Hope it comes up. I'm going to show you the Oracle Trade Alert record here. Let's see. I'm going to pull up. Hold on. Bear with me. Scorecard. All right. Now, here's my scorecard. Let me just go up here. This is. I have some names I'm trying to block out because I just took some notes there. Okay. This is our actual scorecard from the beginning of the year. Now, see these green positives? The way I do this is if I put out an alert, I log in the date that I put the alert in. You can see here. See? I log the date of when the alert went out, the stock, and what my bias was. So in other words, if I put out an alert to buy a stock, my bias is obviously bullish. I put the closing price that the alert went out, and that's the price marked on the alert, the document, and then I have a 3-month trailing price. And I compare the price where it trails to my original bias, and if it goes up and it's a bullish bias, then I mark that as a positive outcome. You see that? Now, we've only had one negative outcome in DLG all year. Now, there might be a chance that we might get stopped out on PFIE down here. I don't know yet. It's still too early to tell. And VRNG, notice I did not mark that yet because it's still at the price that we bought it. JCPenney is still at the price that we bought it. And UUP is still at the price that we bought it. So notice there's no result here because it's still in play. But once the move takes place, I will then mark it positive or negative. So we're very close to having only 2 negative trades all year. Now, think about that. For those of you who are not subscribed to our service, what is that worth to you? Our service, if you're trading exactly to our trades, the service pays for itself. So it's a no-brainer. And you're getting the commentary, and you're getting special alerts. You're getting, when Bill and I are talking about setting up a trade alert on text, so you get a text message when the alert comes out. We're in the process of putting this together through a company called Remind 101. Bill, I'll give you the update on that one. And I'm really proud to show this record. Listen, there are no analysts out there that have over a 70% accuracy. We're pushing over 90% accuracy on our trade alerts, and that's powerful. So I just want to give that to you. This is being recorded, so if you want to go back and mark that, you feel free to look at the date when I placed the trade or the alert. You could look at the history and what happened afterwards. So all these are documented and proven to be good trades. Whereas other trade alert services, I don't want this to sound like a commercial. I really don't. I'm just really proud of what we're doing because we're doing a lot of good for people. The other services out there only show you their good trades. Oh, we were up 300% on XYZ stock, but they didn't show you the other 4 that they lost money on and how they didn't tell you how to get stopped out. You say, we're showing you where to get in, where to get stopped out. In many cases, we're giving you contingency orders. Let me explain that because we're going to show you this on the next trade. CLF, January, it went out as a bullish trade, but it was a contingency to only buy on a green candle, and we never got the green candle, so therefore there's no trades here. These are not counted. Just the alert went out. This is no trade. So it's a neutral, indication at that point. Now let's go back. I'm going to show you what a contingent order looks. What a contingent order looks like. All right. Now KMI. Lana puts this in. Welcome, Lana. KMI. Let's look at this. In at 32. Now look at this. This is beautiful. Now, Lana, I would love it if you could tell me where you got in and what day, because then I could show everyone where the entry point is. But until then, let's draw a line for Lana. Okay? Lana has a beautiful trade here. She got in at 32, very close to the bottom right there. And it's broken out of a cup and handle. Here's the cup. Boom, big cup. Here's the brim of the cup. Here's the handle. So, Lana, you do not want to get out of this one yet because this cup has been broken and it's rallying. However, what you do want to do is you want to put your stop at 36. Below 36.5, which is the role reversal support, you want to move your stop up if you don't have one already. Move it to 36 and you're locking in a $4 profit, which is what? 11.5%, 12% profit. That's what I would do. Now let's see. Lana, did you have a date of when that stock went in? When you got in? Okay. Let's do it this way. Okay. Let's imagine. I'm going to help you and Lana and everybody what a contingent order looks like. So if you get an alert from me and it is a contingency, then you'll know exactly what it is. Now I'm going to zoom here. Now let's imagine for a second that everything above this red line has not occurred yet. All right, try to erase that from your mind and your eye for a second. Here's a cup. Here's a handle. You see that? Let's say an alert goes out on this day. Let's imagine it's June 3rd. It's a green candle, but my alert is buy only when the stock closes over the resistance line. So the contingency is don't buy now. Wait until you see the signal and then buy. So the alert goes out on June 3rd. On June 4th, boom, what happens? The stock closes over the line. Slight, but it does close. If you want to wait one more day, that's okay. Still closes over, you buy it. So the contingency is wait for the stock to break out, then buy it, and then put your stop below support. That's how our alerts work. So if you get a contingent order, do not try to force the trade. Wait for the signal to actually show up, and you're going to increase the profits dramatically in that. So Lana got in mid-March, which is quite some time. So right around here, you got in right around mid-March. Beautiful. Ah, right in there, right on the lows. Nice. Hopefully it was on a green candle and you did everything right. So congratulations on that, Lana, and I look forward to seeing you on many more web seminars. I'm wrapping things up, but remember, if you want to go and subscribe to the Market Guys alert service, I promise you will not be disappointed. Just go to themarketguys.com and click on the tab up top that says Shop. Where is it? There it is. Just click on Shop, and there's our orders. You can subscribe to the monthly Oracle service, the options, and the equity. And if you want to have mentoring, we have private mentoring, although we're not doing anything during the summer. We will be introducing a program in September. If you want to be put on a waiting list for that, just let us know. And I'm as excited as ever. I really am, folks. I'm so optimistic about what's going on, even though everyone's saying the sky's going to fall from the market. Remember, you can make a lot of money if the market goes down and you're prepared for it. You could make a real lot of money, and you won't have to worry about markets crashing. Just learn how to read the charts, learn the signals, and protect yourself with good, solid risk management strategy. So that's it for tonight. Have a great evening, everyone. We'll talk to you soon. Bye-bye.